So first off, I just want to welcome everybody to our session. I am going to switch off the camera just now, just to make sure that I don't have any connectivity issues. I just have something in my throat. It just started just now. So just bear with me. Hopefully it will not continue and it will stop soon. But yeah, so welcome everybody. In today's session, we're going to look at costing and pricing. Like I've always with all these workshops that I do, I don't like to hear myself talk. So if there's any time during the session you have questions, please feel free to raise your hand or unmute and just stop me so that we can have that discussion. Maybe I'm going too fast, or you just want me to explain a bit more on any of the particular slides or information that I'm sharing. So as I said, anytime during the session, and then I need a timekeeper as well. So halfway through, so it's now 9 o'clock, so 10:30ish, that we can just around about there have a 5 or 10 minute comfort break, and then we can continue. So I just need somebody to be my timekeeper for us to have that break. Otherwise I will continue and I will forget that we need a comfort break. So thank you for that. I don't know what's happening with my. Anyway, I'm going to switch my camera off, and then we can start. As I mentioned, today's session we're looking at pricing and costing. But just as a start, let us just first look at financial management. Now, I'm not going to explain all of these during the session. I think the main thing that I want to highlight through this slide is basically that financial management is something that we need to look at, and we need to be top of mind on a continuous basis. It's not something that we do and then we leave it. We need to. It's something that we need to review, look at, consider throughout our business, because financial management is not separate to the business. It's part of the business. It's one of the most important things when we are conducting or running a business. So again, I think this is my slide where I normally preach, but I'm not going to go into too much of that today. I just wanted to highlight that, and I think the circle explains that it is not, it starts with 1 and goes through to 9, but then we start with 9 again. So it's continuously reminding us that we need to have to look at and keep financial management top of mind. So part of financial management, we obviously need to look at the accounting side, and so what do we mean when we talk about accounting? Accounting is basically for us to start talking whatever strategy or goals we have as a business. With accounting, with financial management, we put numbers to those goals, numbers to those that strategy that we have, and then when we start executing that strategy and or achieving those goals, then obviously the numbers that translate into numbers. So we know how much we've spent, the value of the assets that we have, the income we receive, or if we have some debt, then we also would be able to articulate that from a numbers perspective. So when we in business, the reason why we in business is to make a profit. That's unless you're in a non-profit organization, but for us, that's in a normal for-profit business. The reason why we in business is to make a profit. And so looking at that, is that balancing act between the services that we render or the products that we're selling, the expenses that we incur to be able to do that, and then obviously the income, the profit that we generate by doing that. When there's one or two calculations for when we look at our financial statements, again going back to the statement that we in business to make a profit. So things that we in a normal day-to-day business, we come across terms that we're looking at is the markup. And how do we calculate markup? It's your selling price less your cost price divided by the cost price expressed as a percentage, therefore multiplied by 100. So that would be, when we talk about markup, that's the calculation. When we talk about gross profit, the calculation that we're talking about there would be selling price less cost price divided by the selling price in this instance, again expressed as a percentage, therefore multiplied by 100. So when we talk about gross profit, that would be the calculation. Net profit would be your total revenue, your total sales, less all your expenses. And we'll get to the different types of expenses that we get. We will talk about that in more detail later on, but that basically it looks at your total income, total revenue, less your total expenses. And revenue, how do we calculate that? Normally, that would be your selling price multiplied by the number of units that or hours that you've sold. So that's the calculation for selling price. Oh, that's the calculation for revenue. I'm sorry. That's the calculation for revenue. Now, when we when we talk about going into what the discussion for today around pricing and costing, just some pointers, especially those that do business either with a city or any other government institute, things that we need to consider when we look at our costing and pricing in that perspective. But I think some of it will also look in general. So first off, we need to make sure that we always double check that we've included all our all the cost when we determine our prices, that we include all the cost. The reason for that is something small can have a long-term impact on it. And when I talk about something small, could be there was we've known with fuel prices that just that's going all over the place at the moment. So we need to, before we just give out a price, we need to just make sure that we consider that fluctuation in fuel prices or exchange rate if we import products, that we double check if we buy if we have a supplier, either a foreign supplier or somebody else that is importing and then we buy from them. We need to double check what the prices, if there are any of either fuel or exchange rate or any other elements had an impact on the last price that we received from our supplier. So we need to always just check that when we quote or send out information for tenders, we need to make sure that we include, if we are VAT registered business, we need to include 15%, the current rate, 15% on the prices, because we need to remember that the tender document requirements states that prices has to be VAT included. Um, if there are any other special taxes that we need to consider, please do so. Another tip, if I can call it that, is don't try to go in too low. I think we most probably won't go into high, but don't try to be extremes. We should not take we need to consider or need to be aware that whoever is going to review the tenders when they start opening it in and looking and considering it, comparing it with the other tender documents, tenders received, they have a ballpark idea of what the services that they requested, or the goods that they requested. They have a ballpark figure of what that's supposed to cost. So if you go in, especially if you go into low, they might just disqualify you and mark you as a non-responsive, because of the fact that it's your quote does not really make sense to them, because what normally happens, especially if you go into low, is you somewhere along the line you realize, oops, I forgot something, and then there's either you can't complete the project, or there's some issues with that, and then and government needs to, whoever the government organization is, they need to make sure that they safeguard themselves against that. Minimum wages, as an example, could have an impact, because remember that we have that legislation, and if we do, as example, we in the cleaning industry, we need to take that into consideration, that there's a minimum wage that we need to pay our employees, and that will have an impact. If we try to circumvent that, it will show up, and yeah, so we need to make sure that we take that into consideration when we put out pricing during a tender process. In normal circumstances, you may have a markup of 25% on your cost. But when you do tendering, perhaps you can go in at a lower rate. Example that we've used there is either 18, 20%, just examples, but going on a lower rate on your markup, just to be competitive. Because remember, with bid pricing, you don't know what your competitors are doing, and it is very difficult to do this. But if you normally have 25% markup, maybe go in at a lower rate. The reason for the lower rate is there are some costs that you in any case not going to incur. You don't have to advertise that much anymore. You don't have if you win the bid, you don't have to call around too much getting new clients, or travel too much getting new clients in. So there will be some cost savings for you, and therefore it is okay to go in with a lower rate than what you normally would charge the non-government organizations or private individuals. So a lower markup rate is justified because there is some savings that you will get. And all of that said, we fully appreciate and understand that during the tender process, pricing does have a big impact on how we get scored. And currently, any projects that's lower than 50 million, the pricing will have a 80% weight compared to any projects that's more than 50 million rand. Pricing will obviously have a higher rate. About 90% of the points or rating will be for pricing. So yes, the lower the rate, the lower the price, that bidder should win the bid. But we should remember the other things that I've mentioned around, if you try to go in too low, that may also be disqualify you, because of the bid committee would have a ballpark number that they're looking at, and they have that they understand this service or product should be priced at. So just some pointers there around bidding. Now going into some terminology, when we talk about costs and prices and things, we'll explain the difference between what do we mean when we talk about price, and what do we mean when we talk about cost, but just some terminology. So first one, direct costs. What do we mean when we talk about direct costs? That's that cost. If you're a manufacturer of products, or you deliver a specific service, that's that direct cost in to either manufacture that product or buy the product, or to render that service. The direct cost involved with getting that product or that service out there. Indirect costs, on the other hand, would be costs that you need to incur to run a business. Not necessarily, you can't necessarily link that to a specific, the specific product that you are selling or the services that you're rendering, but to run the business, you need to have these type of costs. And examples, not, there's definitely a lot more, but some examples that we have would be if you rent a office building, then the rent that you're paying, your salaries for the management team, or professional fees, accounting fees, bank charges, all of those would be direct costs. You need telephone, stationery, all of that is, you need to incur those to run the business, but it's not necessarily directly linked to the product or services that you're selling. And normally, it would be fixed on month to month. Your web hosting, insurance, all of those are more examples of indirect costs. Profit is the difference between the selling price and our direct costs and indirect costs. So direct and indirect costs, the total cost, we deduct that, the total of that, we deduct that from our selling price, and that would be our profit. So when we look at pricing, and we'll go into these setting up prices, we'll go into that a bit more in detail later on during the session, but just looking at one or two things around that up front. If we talk about the cost plus pricing method, yes, very common way of setting prices. Basically, we take our cost and we add a markup. That's the easiest way for us to calculate prices, and most probably a good starting point for when we putting our tender pricing together. Look at our cost and then put a profit percent of markup percentage on that for us to be able to determine our pricing. For cost plus pricing method, very basic, very easy to calculate, and is looking at costs and put them a marker percentage, profit percentage on that to be able to calculate that. Value-based pricing, this is where we look at what value the customer put on the price and are willing to pay for that price, for that product. And this may be that the value that somebody put on a product could be more than what our cost would be, or the cost plus method would be. So let me just see, I see there's a few comments. Let me just double check if there's anything that is before I continue. Sorry. I'm not sure what the whiteboard too small on my screen.
The screen looks fine on my side. I'm not sure, it might be an issue on your side, Johannes.
Okay, so then.
Thank you. I will check here by my side and I will let you know. Thanks.
Okay, thank you. Okay, just thought there was some okay, so Johannes, let us know, but it seems as if some of the others can see the slides clearly. Again, just talk about the value-based pricing. I mentioned it's the value that the customer put on and are willing to pay, and it could be in that price that the customer put on the product could be higher than the cost plus method. That's what I've said earlier. However, when we, and we'll again elaborate on this a bit more later on, it could, if it's in a commodity environment that you're operating in, it could be that value that the customer is putting on is actually lower than your cost plus pricing method. So you're not going to make that profit that you wanted to, or you could be running a business at a loss. And then the question would be, is it still feasible for you to run this business? But again, detail will follow later. Marginal costing is you have spare capacity, and so you add another project, or another project. You let's say a clothing manufacturer, and you get you can actually within you have capacity in your facility, taking out your normal production, you still have capacity, so you can take on a special project just to cover some costs. So this is when we have spare capacity. Economies of scale is obviously the higher, the more volume you have. The example that we use there, a high value 3-year contract, if you know that that's the what's happening, or that's a tender that you're going for, so you can actually go in at the reduced unit price, because you know at least you will have a contract for 3 years. So just looking at the benefits because of the higher output. So if there's a higher output, you may go in with a reduced price, compared to if it's if the number of units or the hours that you're selling is lower, then obviously you'll go with your normal rate. But as soon as you see that it's a longer term project, then you can go in with a reduced price. Just any. Oh, okay, helping Johannes, looks like it. So just looking at the difference between price and cost. When we talk about price, there we talk about what the buyer pays to acquire a product from you as the seller. So what your customers are will pay for your products. Compared to cost, that will be you as the business, what investment you've made in that product to be able to sell that, either buy the product or produce the product. So whatever expenses you incurred as the seller or as the business, that would be the cost of an item. So your investment in a product. Now, when we look at costing specifically, there are a few things that we need to consider. One, how much the cost? How much does this item that I want to sell, how much does it cost? Now, yes, you can only, I've paid 100 Rand, so that's the cost. But other things, when we look at costs, other things that we should also consider would be transport costs to get that product to my premises for me to sell it. So besides the cost of the product itself, or the manufacturing of the cost of the product, the labor, the raw materials, and all of that, besides that, if you need to pay to get the products delivered to your premises, so that is also cost for the products that you're selling. Or if you look at things like you buy old houses and you renovate the house, and then only you sell the house. So that renovation cost to get that product into a sellable state, that is also part of the cost that you will incur for that product. Another thing around costing that we need to consider is storage. Do you have enough and adequate storage for the products while you're waiting? So the rent of the premises for where you store your product, but maybe you need a cold storage. Then obviously that's an additional cost. Insurance while your products are at that premises, the security to have that products at that premises. So all of that would be part of the cost of storage, part of cost for the business. Shipping, and here we're talking about when you need to deliver your products to your customers. So here, it could be that the products that you're selling is either very heavy, or just different shapes, awkward shapes, or it's fragile. If it's very heavy, then obviously you either need extra manpower or hands to move the products, or you need special equipment to move it. If it's fragile, it obviously, the time you're going to spend to move the products will be more, because you're not going to just throw it from the one to the other, or the people that's helping you to move it. You will take your time, or they will take their time, because it's a fragile project. If it's an awkward shape, maybe the container, normal boxes can go in there, and you can put in, I don't know, 20,000 items in there, but because your stuff is awkwardly shaped, you can only, about 25% of the storage or the container, you can't use it because of the way your item is shaped. So add to the shipping costs. The season when you buy your products, or when you're going to sell it. So we know, example, gardening tools, winter months, it should be a bit cheaper than when it's summer. Nobody wants to garden if it's cold and wet outside. So the demand for gardening tools will be lower in winter. So you may go out and buy some gardening tools, get it at a cheaper rate during winter, and then unsell it during summer at a higher rate. But now again, we need to consider yes, you get it at a cheaper rate and sell it at a make a better profit. But now we need to remember there are other things, storage and all of that, that we again need to consider. But you get I hope you get the picture that during the lower or off season, you can get it at a cheaper rate and sell it at a higher rate, and therefore make a better profit from just the specific costs without the other types of elements that could have an impact. When we talk about product life cycle, here we talk about example. We have when we look at high-tech products, your cell phones and laptops and all of that, we all know that it's normally about 2-3 year lifespan on those type of items. So yes, get it, if you're in that market, buy it, try to sell it when you know there's a big demand for those items, and you can get a lot of sales at the right price. But now we just need to remember, because of the 2-3 year life cycle, we should not be caught with when a new model is coming out. Make sure that you plan your stock holding as such that you don't sit with a lot of stock on hand that you are not able to sell when the new product is coming out. So make sure, we all know that within 2-3 years there will be a new model, sometimes it's even a year, but we should always take into consideration that we don't sit with a lot of excess stock at the end of the life cycle for that specific model, because now we will have to either sell it at a loss or obviously reduce our prices, and therefore not make the profit that we planned on it. So we just need to take that into consideration when we deal or sell products that have a specific product life cycle. A bit more detail around direct costs. We've mentioned earlier that would be the cost that is directly linked to either producing or procuring the products, and raw material, labor, all of those. And if I can use an example for direct costs, you're a wooden chair manufacturer. So the first thing you manufacture wooden chairs, first thing that you will think about is you need to have the wood for those chairs, obviously. But we should not forget that other direct costs in that process would be the glue, for a wood glue for the chairs, the nails if we use any, and then obviously the labor. That's just some examples. There may be some more, but just that is directly linked to make that chair. So when we tender, we need to make sure that we need to have our direct costs. We need to understand what it is, and we need to include that. That's the minimum. We also need to include the indirect costs, but we'll talk about that just now. So when we talk about the indirect costs, and I've mentioned this earlier, that cost that you need to incur to run the business. Not necessarily that you will be able to make a profit because you incur that cost, but you need it to run the business. Some examples that we talk about when we talk about indirect cost is rent, utilities, electricity or water and things like that, your telephone, data, stationery, salaries and wages, especially for management or office staff that's not directly linked to the producing the products, accounting fees, I've mentioned bank charges, I think. So all of those marketing, all of those would be indirect costs and costs that you will incur to run the business, but not necessarily to produce the products. That's a direct cost. Here we talk about those costs that we can't link directly to manufacturing the products. When we talk about costing, different other terms that's also being used when we talk about cost is the fixed or variable cost. Now, what we talk about fixed costs, that's the cost that normally would be fixed in total. So if you produce 10 or 20 or 270,000 items, the products will stay, the fixed costs will stay the same month on month. Again, examples would be rental, management salary, insurance, accounting fees, all of those would be fixed costs. Variable costs, on the other hand, that will have a direct impact, will be impacted directly by the number of products that you've produced or your output. So if you manufacture electricity, wages, raw material, packaging, all of those would be variable costs, because if you have 2,000, what was the number that I gave earlier, or 3 million, you will have, variable costs will increase with the number of items that you've produced. So the total variable cost will increase. As I said, fixed costs, that will stay the same month on month. So the total cost would be your total fixed costs plus your total variable costs. That will be your total cost for the year or the month, whatever period you're reviewing. So next up, we're going to move into talking about pricing. And first question that we need to understand before we go into the detail of how to set the prices and things to consider is just why pricing would be important. If we just look at marketing, from a marketing perspective, if we know that there are different elements in the marketing mix, your product, your location, and all of those, but price obviously is one of that, the levers that you have or pillars that you have within that marketing mix. But we know that if we look at pricing, and why we say it's the most flexible in that marketing mix that we have is if we want to make a change to a product, it will take some time. If we want to change our distribution model, it will take some time. If we want to, if we have a marketing campaign, it's not that we can change that overnight. We need to, there's a specific marketing campaign, a few things that we need to consider before we can change that. But but with pricing, if we're busy negotiating with a potential client, we at that point there, if we are the decision maker around and we have the mandate to change prices, while we're negotiating with the potential client, we can make the decision to change or to give the client a discount or a reduced rate then and there as we talk, as we busy with the negotiation. And that's the reason why I would say it's the most flexible. If our competitors are changing prices, we can we can make the decision to follow that without doing anything else, but to follow that competitive price. If they change their prices, we can follow, and that we can we can just make make the decision and we can execute that. No need for period of time to pause or other things to do. besides just making the decision and implementing it. Setting the right price. And here, obviously, lots of insights that we need to have for us to be able to set the right price. And the reason why we say we need to set the right price, and again, we will go into different steps to follow to get to the right price, is that we know that the first interaction that people normally have with your products would be the price, and that could be that will determine how they perceive your price. But also to set that right price, if we put it too low and our customers are actually willing to pay more for the product, then we're losing out on profit, we're losing out on money. Again, going back to, we in business to make money, so we're losing out on profit to if you go in too low. It could be if we try to increase the price later on, our customers maybe feel aggrieved because they increasing the price without adding any value. Why should I now pay the higher price? So if we go into low, we lose money and may struggle to increase it later. If we go in, on the other hand, too high, then we can just lose sales because nobody wants to buy it, or nobody interacts with the products, so they're just not going, so you're not going to sell anything. So we need to have that sweet spot to with setting the price right. On the other hand, and I think I've touched on this also with setting the right price, that trigger first impression. Again, if we talk about when customers interact with our products, the first thing that they've noticed would be the price, and that will give them an impression or perception around the product. If we targeting the mass market, and we know with the mass market, they're very price sensitive. If our product is just priced a bit more than competitors, then we're going to lose out on the sale because they're going for the lower item. If we obviously if we targeting the high end of consumer, and if we again with them, if we price it too low, then they will think, no, but this thing is the quality, there will be an issue with quality, because they expect to expect to pay a bit more for higher quality product. So depends on the how you set your price. Customers will get an impression around quality and what type of who you're targeting. So again, that first impressions around, because if the pricing will be the first thing that a customer will see when they interact with your products. It's important part of the sales promotion. We can, to gain more market share or increase our volumes, selling products that we've sold, we can use promotions. We can change our pricing and put our products on promotion to gain some market share or sell more items. However, we just need to be careful not to overuse sales promotions, because if we do that, our customers may start anticipating a sales promotion or reduced price, and therefore they will start holding out or wait for the promotion, and that will again have an impact on our sales objectives, or selling the profit that we're making or we plan to make. So yes, pricing is important part of our sales promotion, but we should not overuse sales promotions, or do it too frequently or for too long a period, We just because our customers can then start using, because they anticipate that promotion, reduced price, anticipate that, and that would be for the long run for the business maybe some issues, but we'll talk about that also a bit more later on. Next up, just talking through some factors that will have an impact on our pricing decision. They obviously, I think with any business, there will be internal factors as well as external factors. When we talk about internal factors that can have an impact on our pricing decision, that would be within the business. We as the business owner, we will have an impact on those decisions or on those factors. We will be able to change that, to manipulate that. If, and I'm trying not this as strong, there's not, yeah, anyway, we can change those factors or have an impact or influence over those factors from when it's internally. If it's externally, then it's something that we as the business won't have any control over that. We just need to be aware of what is happening and see how that will have an impact on our pricing decisions. But we will go through the detail just now. So when we talk about internal factors that could have an impact on our pricing decision, one, first of looking at either our company or marketing objectives. And here it could be that we as a business decide that we want a specific return on investment. So a specific percentage of profit we want. And so any of our pricing decisions, we will include that specific return on investment to be able to achieve that objective for us. It could be that all products is at 25%, or we have different divisions, and maybe men's clothing is 20%, but female clothing is 30%, and kids is 25%. You know, if we have different, doesn't mean that it should be the percentage will be the same, but at least we know we have that's our objective for all items. We have a specific profit percentage that we want to achieve. That could be one of the factors, or one of the reasons what will have an impact on our pricing decision. Next up, we could have an objective that, especially if you're new in the market, we will go in and make sure that we at least cover our costs. So make sure that our cash flow, we manage our cash flow, at least cover our costs. So the pricing that we will put on a product is to cover the cost and not necessarily to make a specific profit on the project, but because we want to perhaps gain market share. Therefore, we just want to go in and cover our costs. So that could be an objective of ours. I just spoke about the market share. If we, especially in a very competitive market, if we want to gain market share, then we can make sure that we always lower than our competitors to gain that market share. And that if that is our objective, market share is the objective for the business, then obviously that will have an impact on our pricing decision. Maximizing profit, you may have a item that you're selling, you know there's still a huge demand for that product, for that item, but there's not really an incentive to change or better that specific product. So while there's a demand and while people are still okay to pay a premium for that product, just go ahead and sell and milk it. So maximize your profit, and that's what you're doing. If again, could be a different marketing objectives that you have, maximize profit, and that will have an impact on your pricing decision. If we talk about another internal factor that will have an impact on our pricing is marketing strategy. So it could be that you decide you want to play in the high-end market, then your pricing will be accordingly, because as I mentioned earlier, consumers in that target audience, the high-end consumer, they are willing to pay for quality. So you want to send that message out that your product is high quality, and therefore you will put your price to be able to communicate that. And again, that will have an impact on your pricing decision. On the other spectrum, if you in the mass market, you know your customers are very price sensitive, then you need to make sure that your prices are very competitive. Again, that's your strategy. That will have an impact on your pricing decision. Cost, going back to being in business to make profit. And because of that, if we do our calculations and we are not able to cover the not to make the profit that we want, or the cost is getting out of hand, then we need to do something around the cost to be able to make the profit. Because cost, if we need to cover the cost, we need to at least cover the cost. So that will definitely have an impact on our pricing, because if the cost is going up, then most probably we will want to increase our prices because we want to cover the cost. So cost, we need to internally manage our costs, because that will obviously have a big impact on our pricing decisions. So internally. If we look externally, things that factors that we need to consider when we do our price during our pricing decision process would be competition. And there are three different types of competition that we can look at when and their decisions, how that will impact us. One, similar products. So if there's a market leader and major player in your specific market, they change his products, then normally you will follow. So similar products, then we will, if same products, then or similar products, then we will follow what the market leader is doing. If it's when we talk about related products, that's where we have an online golf course or in-person golf course. We have yoga lessons in person or online, and the list goes on. When you consider your online yoga instructor, or you're a yoga instructor and you want to now give you consider going online with your sessions, then you will use the prices of what an in-person yoga instructor will charge the clients. You will use that as a benchmark. When we do it in person, then either the yoga instructor go to the client's house, so traveling fees and time that needs to be taken into consideration. If it's a venue that they use and group will go there, obviously the venue hire, or they need to hire the venue, and that's additional cost. So obviously if it's in person, it will most probably be a bit higher than if it's online. In online data cost, but if you do it online, most probably be a bit lower than in person, but you will use the in-person as training as a benchmark for how you compare to that. And then when we talk about completely different products, and here I'm not losing it. Here, what we're talking about is accessories, cell phone accessories, as an example, or laptop bags, the mobile phone covers, and things like that. So if there's a big change in the main product, so the laptop bag or the specific cell phone model, if there's a big change in that main product, then you that provide the accessory, the complementary product, you will also need to, or will have to change your price, because you don't want to be seen as half of what the mobile phone costs. So if your cover, normally you about 10% of the your price for a cover is normally about roughly 10% of what the cell phone costs. Then obviously if there's a price change in the main product, you will have to adjust your the price for your product, because obviously again you want to maintain that 10% ratio compared to your price compared to the main product. So that's when we talk about completely different products and more complementary products. Again, you don't have impact or say in changing the price of the mobile phone or the laptop. You don't have a say in that, but you need to be aware of that, and then that will have an impact on what you do. Next up, still external factors that will have an impact on our pricing decision is elasticity of demand. And what we mean by that is how demand will change if there's a change in price. Now, there's different ways, different things that how demand will change. One example that I use is in inelastic demand. We just think back to when we had that hard lockdown a few years back, and cigarettes, that there was a ban on cigarettes. We know that smokers were able to get cigarettes, and not the best quality. We know the smokers were able to get cigarettes at 3 or 4 times more than the normal price of a packet of 20 cigarettes. So inelastic demand. Doesn't matter the price, there will still be a demand. We know if house prices go up, then potential buyers normally wait and not buy. They will rather rent a property than outright buy, because the prices, as soon as the price go up, the demand will decrease. On the other hand, as soon as they see a downward trend in the price of houses, then the demand will increase. So directly, so as soon as the price go up, the demand go down, and vice versa. So the demand is very elastic. So that's another external factor, and things that we need to understand what we're selling, how that will, or what what the demand will do if we increase prices or not. If we talk about customer expectation, it could be that your customer have a specific value that they've put on a item, and they're willing to pay that. If you try to sell it at a higher rate, they won't interact or buy your products, because they have a specific rate in their mind compared to the value that they will get from it. So we need to understand what's our customer expectation, and use that knowledge to be able to gauge, to determine our prices. And then lastly, looking at external factors that can have an impact on our pricing decision is government regulation. Now, with government regulation, we've spoken about the minimum wage. If you in an industry, a service industry, and you need to use general workers, we know there's a specific rate that we need to pay for our employees, and obviously that will have an impact on our pricing. It could be that we importing products and there's some import duties or custom duties that we need to pay for us to be able to import those products. And obviously that will have an impact on our pricing. And if there's a change there, then we will most probably pass that on to our customers. So from a government regulation, again, we as business owners, not a lot of influence on that. Also, if we know there's something that if something changed in that regard, then it will have an impact on us and how we price our products. I'm talking a lot. Any questions, please? I don't as I said earlier, I don't like to hear myself talk, and I've spoken, I think, almost more than an hour now. So please, again, stop me if there's any questions that you have. If I need to explain something again. Let me just see. We said we're going to take a break at 10:30. Johannes, will that still be okay with you? I think that was the arrangement, that we will take a break. Okay. Okay, so next up, we're going to start looking at setting the steps in setting prices. So a few steps that we will have to follow, and I will go through these in detail just now. But yeah, so one is we need to understand what the company or marketing objectives are. Second, we need to determine that initial price. Then we're going to look at standard price adjustments, promotional pricing, and then just understanding the different payment options that's available and how any of the different payment options can also have an impact on how we price our products. Just see, there's another comment there. Okay, thanks, Johannes. So looking at our company or marketing objectives, and we've spoken about this during one of the previous slides. So we as the business need to understand what our objectives are from a company or marketing side, need to understand, because that will be the first step. If it is that our objective is to a specific return on investment or cash flow, or with specific market share that we want to gain or increase our market share, or milking or maximizing profit, let me rather say it like that. If that's our objective, then obviously that is our starting point. Sorry, if it is that we have a specific strategy, talking about how we're focusing, and as an example, on a high-end consumer, if that's our strategy or that's our objective, then obviously that's the first step. And I'm not going to talk too much more on this. I think we've covered all of that already, but that will be the first step in setting our prices. Next, we need to set that initial price. Now, this is that I almost want to say that line in the sand. This is the price that we use to start the conversation, to the list price, the published price, or the price that we use to negotiate. That's where we start. Now, there are different wording for that initial price, as recommended selling price, or manufacturer suggested retail price. So that initial one, and I'll go through how we calculate that just now. But we just need to be aware that with strong brands, normally the market will follow your manufacturer suggested retail price, because consumers will appreciate and understand what that price is, and therefore they will the resellers will demand that from the reseller. So but yeah, so that's normally what happens. That's the initial that initial price at the starting point. So different ways of how we can calculate that initial price is either through the cost-based pricing, market-based pricing, competitor, when we look at competitor pricing, or where we base our pricing based on our competitors, or bid pricing. And these we've touched on earlier already, so I'm going to run through this quickly, and then we can have a break. So cost-based pricing, we look at the cost, we add our profit, but the cost is the base for determining the price. Now, cost-based price, when we use cost as a base for our pricing, that's the easiest, because normally we know what our cost is. So that's the easiest way for us to calculate the prices. But we just need to remember, when we use cost as the base for our pricing, that this is again a very inward looking. We're not considering what the competitors are doing. We're not considering what the market asks or what they expect. We're just inward looking, because it is so easy to calculate, yeah, easy to calculate, but we're not considering what's going on outside. And we can actually, with this method, we can actually outprice ourselves. We can put a too high a price if our cost structure is as such that we have huge expenses. We can put a price on our products that's so high that people are actually not willing to pay for it because it's not competitive. So again, within the cost as a basis for pricing, there are different elements again underneath that, and I will just quickly go and see any comments, and then we'll go through that, or the feedback for please, yeah, remember to complete the attendance register and the feedback form. I think that will be, that's busy sharing that as on the chats. So cost as a base for determining the price. Markup, we add a percentage of markup, and we common normal used method. We have a specific, we know what the cost is, and we add a percentage markup to determine our selling price. So that's the one. The other one is the cost plus pricing method. So if the example we use there, if there's a contractor and they need to tile a bathroom, same size bathroom, they know what their cost would be. So that is they know what their cost would be. If there's a difference in price, it would be the type of tile they need to use, and that obviously is based on what the buyer wants, or the homeowner, what they want, what they've selected. So if the homeowner go with a normal standard tile, low end, obviously the total price that you're going to charge, it will be lower, because this the cost for the labor that you're using. I'm the contractor, the cost of the labor to do to tile the bathroom plus the tiles would be lower than where the homeowner want an imported tile imported from Italy or wherever, a high-end premium price tile. So in that instance, the cost, my cost as the tiler, would be the same in both instances, but the difference in price would be as a result of the specific tile that the homeowner wants. So that's a different method of calculating based on our cost. Another method, but this is let me rather say it's a specific tool that we can use to determine and break-even pricing method. Basically, this tool calculates, and I'm not going to go into all the detail around this because we will share the slides and you can go through that in more detail. But this is a tool for us just to gauge if at a specific selling point, if the volumes that we've calculated, if that makes sense, if it is achievable for us to sell at that specific price point, because we know our fixed costs, we know our total fixed costs, we know our variable cost per unit. So at that specific selling price that we choose, we calculate the break-even units and use that then to understand if it is feasible for us to be able to sell these products. It could happen that at a specific price point, you're selling hours at a specific price point, you determine that for the month, you need to sell 300 hours. And we know there's not 300 hours in a month. If you one person business, you can, the number of hours that you normally or most probably will be able to work is about 160. So if you can't use this as just to this tool, then and you calculate and it comes out to 300 hours that you need to sell, then obviously you need to go back and do a few adjustments. Either you need to increase your selling price per hour, or you need to reduce your fixed cost, or you need to reduce your variable cost to be able to manage that. We need to get into the 160 hours that capacity that we have. Otherwise, obviously, we need to appoint another person, but that will obviously now increase our cost again. So again, a snowball effect. So break-even price method is a specific tool that we can use to determine at this specific price point that we have, will we be able to sell the number of units that we need to break even. And we know what we mean by break even is our total sales is equal to our total cost at that point. Where that's the same, we calculate the number of units and then determine if it is achievable to sell that number of units or hours. So those would be the different methods within the, when we look at the cost plus when we use cost as a basis for determining price. Next would be our market pricing method. With this one, we need to have, there's lots of market insights that we need to do. We need to understand what the consumers expect. We need to understand how they will react with a price increase or price decrease. So if we use market pricing as a method to determine that initial price, there's a lot of, as I said, research and cost involved with this. So the question that we as small business owners, normally we don't necessarily have all the equipment or tools to be able to do proper research. So we will, when we start looking at determining that initial price, I think is not this method and not the other. It is a combination of all of these different methods that we will use, either using cost as our basis or market as our basis, or our competitors' price as a base, but we will use a combination of that to determine our final price for our product. So again, with marketing price, we look at what the market is expecting, and based on that, we will determine our price. Now, some things that we need to consider when we use the market price method, it would be our backward pricing method, where we fully appreciate and understand what the market is willing to pay for the products, and then we work backwards to see if we are able to provide the product or the service at a specific rate. And here we said the market is willing to pay 199 Rand. We know the reseller needs 40 Rand of that for them to make a profit and to be able to stock our products. We need 70 Rand of this total price for our profits, or to be able to cover our other costs. And then, so therefore, we should be able to make, or have to make, the product at 89 Rand. Now, if we do this calculation and we get to the 89 Rand, we now need to go back, do our homework and see, are we able to do that? If we can do it at 89 Rand or lower, then obviously we continue with this product. If not, we have, if the price that we going to incur to produce this is more than 89 Rand, we now need to can do one or two things. We can either not continue with this business, or we need to go back and do our homework around, is there any other things that we can do to change the cost of our products, that we bring down the current price that is more than the 89 Rand to at least 89 Rand for this to be feasible in this scenario. So backwards, working from what is expected in the market, working backwards to understand, are we able to manufacture this? Next up is looking at a psychological pricing method. And here I always smile, because normally when I go into the shops, I do exactly the same. So what happens is business owners, businesses, they put on a price on products just below the full round number. So in my, normally what happens is, if a customer comes in and they see a product priced at 299 Rand and 95 cents, in their mind, that is lower, a lot lower than the 300 Rand in this example. So they see that as, I'm getting this product at 200 and something Rand, where in actual fact it is only a 5 cents difference. But if you put the 300 Rand on there, then most probably people will not want to buy it, because I'm not going to pay 300 Rand for this product. But if I just put or even a 5 cents, 5 Rand lower than 300 Rand, I will buy it because in my mind, I see I bought the product at 200 and something rand instead of it's actually so close to 300 rand. I'm actually buying it for 300 rand. So that odd even method used to persuade customers to buy products, and there's a reason why, and I think something to consider when you put prices on your products. Prestige pricing, again, talking about that high-end customer, when they look at products, if they see that the product is priced at a higher rate, they perceive that product to be of a higher quality, and therefore that's the perception that they will go away with a higher price. So again, if what perception do we want to put out, and if we especially playing and in that field, the high-end field, then price, the higher the price gives the impression that this product is, or it's perceived that the product will then be of higher quality. Price lining. This is what we appreciate, that our market, there may be different needs within the market that we're targeting. Example, when we talk about this, is laptops. We can have an entry-level laptop for our scholars or learners, basic requirements, compared to a gamer or a web designer, or yeah, so the requirements both need a laptop, but the requirements for these two groups would be different. So obviously, when you in a market like that, you have different options for these different segments within your target market. Another option around this would be, let's say Mercedes-Benz. Mercedes-Benz has a lower, a series that is a bit cheaper, if I can call it cheaper, you know, your A-class, normally a bit not that expensive, compared to the E-series or the S-series or whatever the high-end model would be. So Mercedes-Benz knows that they have a target market, people that wants to buy the products, but not all will be able to afford the E or S series, and some would be okay to drive a A series. At least it's the Mercedes-Benz that they're driving. So again, target market, but different needs within the target market. So again, we understand what our the market wants, and we cater for those different segments within that specific target market. But we also need to remember that there could be some increased profitability, depends on the functionality. If we go back to the laptop, the functionality that a learner or scholar needs compared to the rest, the added functionality that you've put in your mid or a premium product could be the cost for that change could be minimum, but you can put a higher price, higher increase in price between the different models, and therefore increase your profitability. That could happen. I'm not saying it will happen, but that's something that will also add to people using this as a to differentiate between the different models within their range. Lastly, before we take the break, is just looking at competitive pricing. And here what we're saying is we use our competitors as a um, um, we use the competitors' pricing as um, a basis for us to determine our prices. So um, normally we will use, if there's a specific market leader or some big players within the market that we are operating in, if we're a small player, then we will follow those dominant competitors. We will follow their pricing if we use this method. And things that we can do, we can either go in at the same or just below them because we want to gain market share, and we say, okay, but we have a similar product or similar quality at a lower rate, want to gain market share, or we will go in at just above the competitive price because we want to send out the message that we of high we have a higher quality, we more prestigious than the competitor, so that therefore we will go in at just a bit higher than what they have, or we will go in at parity, simple method. No, we can go in with same pricing, but we have add-ons. We we have add-ons, or we can have same price, but we have we talk about the different quality that we have or added services that we provide. So, but use the competitor as the method to determine our pricing. And then lastly, bid pricing, we've spoken about this in the previously, most difficult one when we determine pricing, because we have no idea what our competitors are doing. The only time we will be able to have a view of what the competitors are doing is when they open the bids, the tender documents. That's when we have will be able to gain insights into what our competitors, what prices our competitors are putting on there. But pricing normal standard for our when we deal with local, national, or international governments. And as I said, the most challenging of method to put that initial price on. So that is looking at the second step, where we determine that initial price, so the different methods of how we can determine that different steps. So before we move on, I think we can have, should we do a 10-minute break, and then we will continue with the price adjustments. So 10-minute break. So I'll see you back at 10:40, and then we continue with the session. You can just mute yourself, and then when we start again, we will just continue. Hi, I hope everybody is back. We can continue with the session. Just close here. So next up, what we're going to look at is just the next step in our price setting process is looking at standard price adjustments. I hope everybody can hear me and we're all back and you can still see my screen. I'm going to assume silence would be that everything is still on track. Okay.
Yep, we can proceed.
Okay. So as I said, we're looking at the standard price adjustments, the third step in our process. And when we talk about standard price adjustments, so remember we set our initial price. This would be an adjustment. Normally, when we talk about standard price adjustment, normally it will be a normal part of our price structure. So if we talk about adjustments, normally it will means that there will be a decrease in the initial price. But with the standard price adjustment, that's not necessarily the case. In some instances, you will definitely have a increase in price, but we will go through that again. So we have the different price adjustments that we can have is the standard price adjustment and the promotional price adjustment. And we will talk about the promotional just now, but with the standard price adjustment, it's a normal part of our price structure, but although in most instances it will have a decrease in price, but there could be instances where it could lead to an increase in price. The different types of adjustments that we can look at when we talk about the standard price adjustments as quantity discount, trade allowances, special segment pricing, and geographic pricing, and I will go through that just now. When we talk about quantity discounts, that's where we basically want our customers to buy more, and when they buy more, they will be incentivized. Example, when they buy 100 or more items, they will get a discount of 5%. This will normally happens, yeah, as I said, it depends on the number of products that they start buying or the number of times that they've used your services. We have a quantity discount can be at the time of the purchase. So you buy 100 items, therefore you get the discount. Or you buy whatever the terms would be. So the more you buy, you will get a discount. Could be that it is discounts on accumulative purchases, where the customer will be incentivized because they repeat purchases. So you buy the loyalty of your customer. So after 10 times you go to a hairdresser and had a color, put color on your hair, the 11th time you go there, they'll do the color for free. Or you go to Marcel's for ice cream or Spur and have a specific meal, you will, after a few times, depend on their terms, after 10 Marcel yogurts or 10 times you go to Spur, you'll get a discount on the one that you go there afterwards. So buying loyalty with when you get the discount at the time of purchase, you want to incentivize people to buy more, and therefore you'll get give them a discount the higher the number of units that they're buying. Trade allowances, this is when you incentivize your trade partners. So you may be the manufacturer of a specific product, but you use distributors or retailers to sell your products to the end consumer. So you incentivize your trading partner. So you give them what they call a trade allowance. So you have your list price or recommended selling price to your customer, to the end user. You've said that, but you sell to your trading partner at a lower rate, and the difference between your price to your trading partner and what they're selling it at, that's their profit that they're making, and then therefore their incentive to stock your products. Example that was used, that we use for this one, your recommended selling price is R2.95. You sell it to the reseller, your trading partner, at R1.95. Therefore, they will make a R1 profit, or 33% profit on the products that they stock on your behalf, sell on your behalf, interact with customers on your behalf, and give feedback to you as the manufacturer. And therefore, and for that, they will be incentivized, and they get that rate as a to cover their costs. So trade allowance, the selling price to the end user is the same that you normally have, but it's the when you use different trading partners, you will have a lower rate to your trading partner to incentivize them to stock your products. Next, still part of your standard price adjustments would be special segment pricing, and this is either you will use this either to build a future demand, or work on your brand image, improve your brand image, or just reward long-term customers. And examples of this would be, you have a special rate for senior citizens at the movie theater or fitness facility, or pharmaceutical firms have a lower rate for senior citizens, building brand image. You concern or you care about senior citizens. Or you have a special rate for non-profit customers compared to what you will charge a for-profit organization. You have lower rates for students or children, again building that future demand, so you have a lower rate for them. Or just for convenience, you will have different rates. You look at the sporting event, when you buy a ticket on them, and it's at a soccer match or rugby match, the ticket where you sit on the middle line compared to at the back of the goalpost will be different, because middle line you will have a better view of the whole field compared to behind the goalpost, obviously limited view, especially on the far end of the field. So different pricing. So special price segments still part of your standard price adjustments. And here, some have an impact on decreasing it. Some will have, or normally will have an increase in, impact on decreasing prices for specific segments, but still part of the standard price adjustment. Normal, you provide that on a normally continuous basis. And then last item under your standard price adjustment would be geographic pricing. Now with geographic pricing, we talk about basically delivery fees. In most instances, talk about delivery fees. So with delivery fees, this would actually increase your price. So example, I'm a manufacturer, I need to send products to Cape Town and Pretoria. So I'm in Johannesburg, so obviously the transport to Pretoria would be a lot less than when I need to ship items to Cape Town. So the price that I will uncharge my delivery fees. If that's part of the structure, I will uncharge my delivery fees. Therefore, the person in Cape Town will pay more for the products because the delivery fees are included, compared to my customer in Pretoria. They will pay a lower rate because of the proximity of where they base compared to where my manufacturing plant is. The other example of impact from a geographic point of view would be import duties or special and taxes when you import products from different areas, or the specific levies that government would put on there, that you in most instances will uncharge to your customers, and therefore also increase the price of the products that you're selling. So all of these standard price adjustments, part of the normal pricing arrangement that you have. Next up, we look at the fourth step in our process to set prices would be your promotional pricing. And when I talk about promotional pricing, the main reason for doing promotions is to stimulate demand. So we want more people to buy our products. Promotional pricing is normally for a specific period, so temporary, only for a specific period, and after that the prices will go back to the normal price of the normal selling price. And again, we need to make sure that we don't overuse this process, because it could happen that our customers start anticipating those promotions, and therefore they will wait till you drop the price, buy the products, and then therefore you may have some issues around your objectives, profit objectives that you've set. So you need to remember that promotional pricing is normally is to increase demand, try to sell more, but we need to remember it is temporary and we need to go back otherwise, and not use it too often or too regularly, because people may start anticipating it and therefore wait for the promotion, and then the business will make less profit. Different ways of how we can use promotional pricing, markdown, loss leaders, and I will go through that, the sales promotions, bundle pricing, and dynamic pricing. We will go through that just now. When we talk about markdowns, here we mark the price down, sell it at a lower rate, and after we've done that, we'll go back to the normal selling price. And there are different reasons why we will mark down products. It could be just a temporary markdown, a sale that we put in to stimulate the demand, as we said. We'll go back to the normal price after that period that we've put the mark, after the sale of that we have. Permanent markdown, and yes, I'm contradicting myself where I said promotional prices, pricing normally is temporary of nature, but when we talk about permanent markdown, yeah, it is, we actually no longer want to have these products in stock. We want to move it out of stock, and there could be specific reasons why we'll do that. It's either it is perishable products and it's going to get to the sell-by date soon, bread, fruit, veggies, things like that. So we try to sell it, the closer it gets to the sell-by date, we try to get rid of it so that we at least get it out and not need to throw the stuff away and then just lose out on the cost. Or we'd still want to make a bit of a profit, or at least just cover our costs. So permanent markdown, in those instances, we just want to get rid of that. Or it's an older model, and we know the new model is coming up soon. So we want to get rid of that old models. Remember at the beginning, I spoke about that excess stock that we talk about, and we know the new model is coming in. So now we want to get rid of the old model. So we are selling the old model at a reduced price to get rid of that, because we know the new model is coming in, and then the demand for the old one is not going to be that great anymore. So we want to just move these old models out of our stock. Or we just decide that the specific product, we just don't want to stock it anymore. So we just want to get rid of it. So we sell it at a reduced rate just to get rid of it. And yeah, so at least cover our costs or make a smaller margin or a profit on it, but we just want to get it out of stock, and we're not going to stock it in future. And then the last type of markdown that we will get is your seasonal markdowns. So just after the high season, we will have a sale and yeah. So examples that we can think about: swimming wear at the end of, I think, February or maybe January already. People start having sales on swimwear and clothing that we normally would use in summer, or just here in September, August, September, they have a sale on jerseys and all the Spencers and all of those type of things, just to get rid of that old stock that's seasonally based. Gardening tools is another example of items that we will use most probably more in summer than in winter. So you will have a sale on the items that is just after the season, because we know that the prime selling period is now done, and we want to get rid of the stock that is based for that peak season. We want to get rid of it just after that time period. Next up, when we talk about promotional pricing, we talk about loss leaders. Now, this is another method that you can use, and normally people will, what resellers would do with and why they would use a loss leader is they will price down one specific item, promote that to make sure that they get feet in the door and get people to come in, buy products, come in to buy that specific product that is on sale, because yeah, it's at a very good rate. And the reason why resellers will do that is to make sure that people will come into the store on the assumption that they're not only going to buy that specific product, they're going to come in and they're going to buy other products that's marked at that's sold price at the normal rate, and therefore they will make up the loss that they're making on that specific item that they use to entice people to come into the store. They will make up that loss because people are buying other products as well. Example here, I'm using Mug and Bean at any coffee shop as an example. They give a sale on a coffee, a cup of coffee, but we know we go in there, we're not normally only going to have coffee, we will have something with the coffee, either a muffin or piece of cake or breakfast or whatever else. So they get people to come into the store to buy coffee, but they know people will buy other stuff as well, and they will make up the loss that they made with selling the coffee at the reduced price. They will make up with the other products that they're also selling. Other promotions that we can look at or use would be rebates, coupons, trade-in, and loyalty programs, all used to stimulate demand and get people to buy from us. Oh, sorry. Another way of doing a promotion, a method that we can use is bundle pricing. Basically, what we mean with that one is we have 2 or 3 different items that we sell in a bundle, and when they buy the bundle, they pay a little bit less for the bundle compared to when they buy the products separately. Things that I can think of is a gift bag, or normally around Mother's Day or Father's Day, you have a little bit of a gift bag and you put different items in there. You sell it as a bundle compared to when you sell it different, separate, the items that you sell separately, essential oils and a nice candle as an example. If that's what you stock, then you sell that as a bundle. But if you sell it individually, the price for the individual products compared to the gift bag is more than the gift bag, the total with the bundle that you're selling. Another example, if you can think on this one, would be McDonald's meals. If you buy those items separately, you will obviously pay a bit more for the burger and the chips and the Coke separately compared to when you buy it in a meal format. So different ways of how people get different items that you put together in a bundle, sell that at a lower rate, and therefore also obviously increase your sales. Dynamic pricing, when we talk about dynamic pricing, still part of the promotional pricing step. Dynamic pricing is basically where we have a adjustment to the normal selling price at the point of sale. So examples that we can use here is your first time buyer on a specific website, clothing or whatever. Your first time buyer, the software can pick up that your based on your whatever information that they have on you, they can pick up that it's the first time that you buy on the specific website, so they give you a discount because you're a first-time buyer on their website compared to somebody else that is a regular buyer on the website. So normal prices will be applicable to the rest of their customers, but because you're a first-time buyer, you will get the discount. So again, it's at the point of sale where it is determined, given specific criteria, if you get a discount or not. Another example of this would be buying airline tickets based on the time of time and day that you buy the ticket, or the duration before you buy the ticket, and all of that can have an impact on the price that you will pay for that specific ticket that you're buying. So again, currently with all the software and stuff that's out there, it can be determined, and you will have a different price than the normal rate. So dynamic pricing, that at the point of sale, that the different price will be determined. So that's all the promotional pricing, looking at different ways of how we can have promotions, different prices on your products. When you talk about promotional pricing, these would normally be a short, temporary of nature, so short term, and it's also always reduce the from the normal price. You will pay a lower rate than the normal price. So all these that we've just spoken about will reduce the price. Next, when we look at the different steps that we talk about when we determine our pricing, would be the payment options. So when we sell products, normally we want to be paid for it, but the way in how we get paid can differ. Normally we want a monetary payment, so you can either get cash or money orders, credit, pay by credit card, online payment system, or when it's international purchases, then obviously different ways of how we make that payment. But with each and one of these different forms of payment, there could be some cost implications with that, but obviously these would be the normal ways of how we can get paid. Still looking at the payment options, we also need to look at the time frame of our payment. Again, different ways of different times when we can get the payment. It could be that we get payment in full immediately. So as we do the transaction, we get paid for it, or we get a upfront payment and the rest of it will be paid in future. The payment in future could be either full payment in a month, in 30 days, or in installments. So over 3 or 4 or 5 or how many installments in future dates where how we get paid. Or we can have all the payment will be on future dates. So we buy the products now and we pay it off over a period of time. Again, with each of these, we'll have different implications. When we have those future date payments, we obviously need to make sure that we have people in-house that will be able to follow up on those payments. We need to make sure that we have credit checks and have done all of that. When we have the that we at least get paid when based on the credit rating and things like that. So again, different ways, different things that we need to consider when we look at the time frame of when we get payments, but different ways of how we can get that payment. Other things that we need to consider when we talk about setting the price, we also look at ownership. The one is when you sell a product, the ownership would go from you as the seller to the buyer. So ownership will move over and you get paid for that. Otherwise, you can get paid for the use of your products. In those instances, you lease out a premises for accommodation or office buildings. So the use of the building, the buyer will buy the use of it and not the building itself. Or car rental, the use of the internet, all of those manufacturing equipment. I think that's, yeah, there's a few examples in there that we've listed there. So different ways of how you pay for the use of the product instead of where ownership will move over to the customer. Full ownership will move over, just the use of the product and not the ownership. When we in any business, cash is king. So we want to incentivize our clients that are working, that we have agreements with, that they don't have to pay up front. They can pay, as an example, in 30 or 60 days. So we can, to entice them to pay their invoices earlier, we can have early payment incentive put in place, where we basically, in the example there, we give the a customer a 2% discount if they pay their invoice within 10 days. If not, the normal rate, the normal price that's on the invoice will be applicable. And in this instance, the terms would be they need to pay it in 30 days. So incentivize them to pay earlier. So you give them a little bit of a discount, or for them to pay you earlier, you get the money quicker. And that is obviously better than wait for 30 days to get the money. But obviously do your calculations. But this is a nice tool to use to incentivize your customers to pay earlier. Other considerations that we should take into consideration is currency. When you start thinking about exporting, in your country, example that we talk about here is in your country, you may focus on the mass market, as that's the market that you want to service with your product. When you start exporting that product, it could happen that in the export country, the price point that you have could be that it actually put that product in the mid-price range. And now you need to just have that take that into consideration, because obviously your marketing campaign has to be different. Or is it that you're now going to actually drop your price if you still want to talk to the mass market, price sensitive customers? Will you drop your price actually to be able to still service that specific market? So if you start exporting, think about you need to understand what is happening in the export country and how you will then have to position yourself in that country based on the prices that you charge and the products that you're selling. I think this is the last item, talking about your auction pricing, or another item that we need to consider when we look at auction pricing. This is obviously the opposite than the bid pricing. And here the seller doesn't have any control on what the price is that they're going to set. The marketplace basically would determine that. Examples that we talk about is eBay, where they use auctions. There's different auction houses still out there where you as a seller don't necessarily have the influence on what the final price would be, unless obviously you put in a minimum price and that, or a reserve price, and that's the price. Anything above that, but if that minimum price hasn't even been reached, then obviously you're not going to sell the product. So that's when we talk about auction pricing. You as a seller don't have any control over the final price. So we just need to make sure that things to consider when we set our product price is the cost of our production or the products, the market demand for our products, and the desired market markup that the business owner will have. So those elements we need to take into consideration, but then all looking at based on each of these items obviously has some other impacts that we've just discussed. So before we move to the last part of the presentation, any questions so far? Anything that we want to still, you want me to repeat or to highlight or to challenge? Anything else? If nothing, then obviously no hands or no, silence, I'm going to continue. But if there are any questions, please feel free. Okay, as I said, silence, I'm going to continue. Last part of the session is just looking at, oh, sorry, looking at the processes within government and a few other items that we just wanted to highlight as part of the session. So when we trade with government, we need to understand that there are a few things that has been put in place. So just a quick overview of your supply chain management. Obviously, things that we need to, that's how government wants to, or foresee how they want to trade, is everything need to be fair, equitable, transparent, competitive, and cost effective. So that's one of the regulations that they work on. However, we also need to remember that with the regulations that's put in, there is provision for advancement of persons that was previously discriminated against. So looking at the current structure, specific, there are definitely categories that will will be give preferential treatment within the supply chain management from government. One of the things we know, or before we go there, things that we need to remember within the procurement policy framework, pricing, there's all projects that's below 50 million, sorry, that's above 50 million, will have a point system, a preference point system of 90% to price and 10% to the rest. So that's how the weighting for pricing will be 90% if for all projects more than 50 million. For all projects between 30,000 up to 50 million, the policy or the pricing will weigh 80% of that. So the pricing will be a bit lower, but at 80%, the pricing will be weighted. Just for everybody to understand, so EMEs would be the smallest type of entities that you will get, and that is normally for how you get classified as an EME. It's annual turnover of 10 million or less. QSE is they will have a turnover of 10 million, between 10 million and 50 million, and GNs will have, those are the bigger organizations, and they have a turnover in excess of 50 million. EMEs by default will have a level 4 BBBE status, but this will be adjusted if there's a black ownership. So when an EME has a 50% black ownership, that BBBE rating will move to a level 2. And then if an EME has 100% black ownership, the BBBE status will then be at the level 1. So I just thought we need to just clarify that. I assume most probably everybody is on par with that. See if there's a question. Edwina asked around the 90%. So the 90% means that your if they review your during the tender process, when they review the tenders, if the project that you've tender for is more than total cost for that project is more than 50 million, 90% of the, when they rate your tender submission, 90% of the points that you will score will be weighted to pricing, compared to if the total cost for the project that you tender for is between 30,000 and but below 50 million, the pricing, the weighting on price is 80%. I hope that answers the question. Okay. The different bidding thresholds, different types of ways of how government can procure items from the okay, thanks Edwina, I'm glad I was able to answer you there. No man, the different types of methods of how government can buy products from the private sector is either through petty cash purchase, a verbal or written quotation, written price quotation, and competitive bidding, and there's values attached to all of this. So when we talk about the petty cash purchase, that will be anything that up to 2,000 Rand, that will be part of, if government is buying something that is up to 2,000 Rand, that would be a petty cash purchase. Otherwise, if it's between 2,000 and 10,000 Rand, a written or verbal quotation, and that's what they would need to be able to buy or like to enter into a contract for those values. Anything more than 10,000 but still under 200,000, they would need a written price quotation for them to be able to enter into those contracts. And any project that is the total cost is more than 200,000, there need to be a competitive bidding. Hope that makes sense. Okay, when we do our pricing and we put that through, just remember, this is just an example, but just remember when we put that through on the system that we read especially and adhere to this area here, read how they will perceive it. You need to put prices against each line item. If you don't put something there, it means how they see it is you actually not quoting for that specific line item. If you put the 0 there, then they will seeing it as it's going to be offered as at a free of charge. But just make sure that when you complete the price schedule, that you complete it as thoroughly as possible, making sure you provide the right information for each line. Then just last few slides, again, making sure that we understand what all these different terminology would mean. When we talk about bribing, that's when we understood that there was money or services offered to gain an advantage, and then we can say active bribery and who's the passive bribery, the one who's getting the bribe, that will be seen as passive, and if you, and hopefully you're not, but whoever is initiating and providing the money or the benefit, they are seen as the active participant in this bribery relationship. Fraud involves some kind of deceit or manipulation or distortion of information by a public officer with the intention to seek personal gain. So that's what, when we talk about fraud, that's what we talk about. And extortion means causing harm or threatening a person in order to gain something. So yeah, and we know, yes, I think it is important for us to understand the different meanings and hopefully steer clear of these practices. When we look at bidding and different rigging that takes place around bidding, bid rigging takes place when companies conspire to fix the price for goods or services purchased through a bidding process. So that's normally what when we talk about they conspire to fix pricing. Manipulation of bids, that's when the procurement offer tampers with the bid after submission in order to ensure that a predetermined company is awarded the tender. So that would be manipulation of the bids. When we say rig specifications, the public procurement officer modifies the criteria in the request for proposals to fit a specific company. So that's why when we talk about rig specifications, that's what we talk about. There's they modifies the criteria to fit a specific company, or unbalanced bidding. Procurement officer provides the favored firm relevant information that's not shared with the other in the process. Collusive bidding, basically where the this is more on the supplier side, where different contractors work together to do any of these, either complementary bidding or bid suppression, bid rotation, or market division. The one is the participant in the bidding process agrees to put forward a bid that's higher than the other bidders to be able to make sure that the appointed bidder gets the product. So yes, there are a few people that's bidding, but we know who's going to get the bid, but the others will put in a bid, but at a higher rate. A bid suppression occurs when one or more of the competitors agree to refrain from bidding so that one of the competitors gets the contract. Or when we talk about bid rotation, is we agree, a few companies agree, or competitors agree on who would be the successful bidder, and so they will rotate that who will get the contract between them. And then market division is again the competitors agree to segment the market, and they will, each one of them will then bid in that specific segment, and therefore not compete with each other, again to make sure that whoever is doing the bidding, that they will win. And yeah, so this is when we talk about collusive bidding, that is different ways of how that will happen or could happen, let me rather say that. Then lastly, just looking at the various types of audits that you can get, or when we talk about an unqualified audit, that means it was a clean audit. Everything that has been done was done as it should be. You can get an unqualified audit with findings. So most of the stuff was okay, not too bad, but there are few elements that the auditors will highlight to where there was a compromise of accountability, and so they will highlight those elements and put that forward in their report. The qualified audit, so what that means is the affairs of that department definitely was not managed and well, and there's some stuff that hasn't happened, that hasn't happened as it should have been. So did not manage and account for finance to achieve best results. So some processes that hasn't been followed, or that should be better in future, hopefully. Adverse audit, a lot of problems everywhere, and nothing done according to the correct rules and procedures. When there's an adverse audit, that's basically what it means for that department. And then lastly, when a department or any business gets a disclaimer, that means things were so bad they couldn't even produce reliable evidence to support financial statements. So there's just nothing is going right in that department or that business. So the auditors will put a disclaimer when they issue their audit report. They will put it as a disclaimer, because you can't actually rely on the financial statements, because the processes and it just wasn't followed. And yeah, so that's that. So those would be the communication. If you need any support, or yeah, that's the contact details for the Business Hub. And if you need to get hold of Halid, then there's his WhatsApp number. Yeah, so we have, remember, so we at the end, sorry, we're at the end of the slideshow, but I am available for any questions that you have. But please remember to sign the attendance register and also to complete the feedback form.